Hello, everybody, and thank you for joining us on our Zoom and Learn Wednesday. We have a great Zoom and Learn for you guys today. It is a 1031 exchange alternative that will still allow you to defer your capital gains up to 30 years with a whole bunch of other perks that are different than the strict 1031. So with that said, I'm going to introduce our guest speaker is Miss Brenda Hale. And Brenda, I'm going to allow you to introduce yourself, tell everybody who you are, your credentials, etc.
Okay. Hi, everyone. Thanks for allowing me to speak today, Tommy and Annie. My name is Brenda Hale. Some of you know me as a real estate agent, which I am. However, real estate is pretty much my second profession. I just dabble in that. I am, my primary profession is as a financial advisor. I've been in the financial services business since 2001. I started out with in life insurance sales, working with the senior market, mainly doing 401k rollovers and long-term care and estate planning. From there, I also ventured into lending because I had a lot of clients that couldn't afford long-term care, but they had a lot of equity. I just found out about the reverse mortgages at the time, and there weren't too many companies or lenders that were doing that. So in order to speak to my clients about that legally, I became licensed so that I could talk to them. And then I would go ahead and refer that to the lender so that they can get their plan. So that's why I'm pretty much familiar with all three of those industries, which is why I like this particular product, because it kind of ties all three of them together.
So tell us, what is the product that you're going to tell us about today?
Today, this is called a monetized installment sale, which is a product of the IRS tax code 453 that allows you to sell your capital asset over $500,000 and defer the capital gains tax for 30 years.
All right. Well, I'm excited about this one because it was something new to me. And I know a lot of agents that I work with run into, with the 1031 exchange, a lot of strict timelines, right, and guidelines that you have to meet, and they're hard deadlines, and it makes it very difficult sometimes to, find a replacement property in time to be able to roll those funds into. So I'm excited to hear about this. I'm hoping everybody can see the screen.
Exactly. That's why I thought,
okay.
Excuse me, this will be a good time, because I figure in light of what's been happening, that a lot of investors probably are having difficulties meeting those deadlines because of the pandemic, and a lot of people may have froze and just took their properties off the market, or especially the hotels. No one's wanting to buy a hotel right now or a restaurant. So they're going to need to find a way to, because I don't think the government gave a break on extending the deadlines for the capital gains taxes, or those timelines for the investment properties. So they, if someone is coming close to that deadline, at this point, they can convert. Even if they're in escrow, they can switch over to a 1031 exchange. Or if they haven't found a replacement property, they can arrange for one of these to take place.
Gotcha. All right. Well, the platform is yours. Your presentation's on the screen. And please walk us through this.
Alrighty. So this is just the headline page. It's pretty much just a brief description of what we're going to go over today. It shows you how you can sell your high valued asset and obtain cash equivalent to 93.3% of the net sales proceeds, and also defer your capital gains tax for 30 years. And I have to read the disclaimer. We do not give legal or tax advice, and you're strongly encouraged to seek appropriate tax and legal counsel regarding your individual situation. We just make recommendations, but you need to have it reviewed by a professional. Okay, this is pretty much just, I had already said, we're going to introduce you to how owners of businesses of real estate and other capital assets and sell their asset, defer the taxes for decades, and receive at close of escrow a tax-free amount nearly equivalent to the sales proceeds. Okay, and as a tax planning approach, the installment sale is part of the IRS Code 453, and it is coupled with a monetized loan, and that's why they call it the M453 Sale.
Gotcha.
And this here is just a definition of what that means. Okay. The Office of the Chief Counsel of the IRS issued a memorandum in support of this sale back in 2012. So they've actually had been in place before this, but it actually became more recognized in 2012. Okay. Again, why this works is that the foundation for the tax side of the installment sale, the tax planning approach of Section 453 of the Internal Revenue Code, like I said, it's been around since 1913. In that section, the installment sale reporting section of the code, it declares the general principle that when a taxpayer sells a capital asset and does not receive full payment of the selling price in a year of the sale, that transaction is an installment sale for which the seller owes the tax pro rata as and when the principal was received. So in 1980, Congress said that a seller could receive loan proceeds in connection with an installment sale contract and still receive tax deferral. In a sense, when you get the money from the lender, that's not income, that's debt. So therefore, debt is not taxable. Okay. And this here is one showing that a ruling for the U.S. Bankruptcy Court in 2014, a person that was in bankruptcy, the creditors thought they could come in and seize the sale and get get their debt from the sale of the proceeds. However, the courts ruled against them because they took out the monetized installment sale, which was a loan. So they can't collect debt from a loan. And that's what that order was for. And same with the Securities and Exchange Commission. They came on board with it as well. Okay, the next one. The next three slides are case studies of different companies that have used the monetized installment sale, well-known companies such as OfficeMax, Kimberly-Clark, Plum Creek, a couple international paper. I can go ahead to the next ones. Since he's recording this, if you want to get more information, when you get you can get a copy of the PowerPoint and click on all additional links and it'll give you more information on the transaction. But there's more of the details on what they sold it for and what they earned. For example, the Kimberly-Clark, they sold for $617 million in a monetized installment sale. So this has been going on for the large corporations for decades. Now we're going to introduce it to us small fishes. Okay. I'll get to the next one. That's more of the details. Okay, and here is an actual example of a sale. Okay, this commercial property was sold for $1.8 million. The cost basis, that's what they paid for it in the year that it was purchased, was $450,000. The cost of improvements, $200,000. And then the depreciation recapture. So you would subtract the $450,000 and the $200,000 from the sales price. You would add back the depreciation to, this is, when we do the workup sheet. You add back the depreciation because you have to pay that back. And then you subtract the closing costs, which would be the realtor's fees, title, escrow, anything that has to do with closing. And in case you're a real estate agent on this call, and if this was already in escrow, or if you had the listing and it didn't go into escrow and you're worried about, oh, well, how am I going to get paid if this doesn't close? Well, when this becomes a monetized installment transaction, you're still considered part of the closing cost. Your sales, your commissions are built into that, whether it closes with a buyer or with a dealer. So the real estate agents will still be compensated.
Let me ask a quick question in there then. So say a real estate agent has a transaction and it's a 1031 exchange, meaning it's already started as a 1031 exchange, but they're coming down to the wire. They haven't they haven't found a property, a replacement property, and the time is ticking and it's running out, and they're coming to the deadline of when they need to basically say that they found a replacement property. Can they, at that point, when they know they're not going to find one or they haven't found one yet, can it switch to this type of sale?
Yes, that's when we would call it a bailout.
Okay.
So that's when it can switch to, we would do an addendum and introduce a third-party intermediary, bring the dealer in, and convert it to that particular sale. And as I stated, it would still continue as usual, and the real estate agents, escrow, title, everyone would be compensated. Okay, so on this particular, the capital gains tax that would, well, the amount that would be subject to capital gains tax would have been $1,111,545. So here in the state of California, that's equivalent to about 37.1%. So without using the monetized installment sale, the tax bill for this transaction would have been $412,383.37. So you go to the next slide. So instead of writing a check to Uncle Sam for that $412,383.37, you can take for the next 30 years and put that into another investment. And this is an example of if someone had just maybe just a 5% modest rate of return over 30 years, they'll turn that into $3 million. At that time, the 30 years, when the 30 years is, at the end of the 30 years, that $412,000 does become payable to the IRS with no interest. You know, just whatever it was at that time, that's how much is due in 30 years, which you have more than enough now to pay for that. Or, as some people do, they may put some aside into some type of legacy plan or estate plan or insurance vehicle to cover that for their heirs if they were to pass away. Okay, so the cost for the one that the monetized installment sale is 6.7%. So that's why we say you would get about 93.3% of the net sales proceeds. Okay, so the way to sell your assets is, one reason is to postpone constructive receipt. Also, yes, of course, to postpone the tax bill and still receive cash at the close of escrow nearly equal to the selling price. So that would be the, and here the net sales price is the cost basis minus the commissions, minus the closing costs, and that's the net sales proceeds for this particular transaction. Okay, the next slide. Also, the minimum asset has to be valued at $500,000. It won't go below $500,000. There's no maximum. It's infinity for the sales amount. And the strategy works for capital gains taxes, cancellation of debt, debt over basis, which here in parentheses is people that have absolutely no equity to just use their home like an ATM. As soon as they get some, they take it out. Depreciation recapture, expected failure of the 1031 exchange, that's the bailout, or the prepayment of an existing installment debt owed. Okay. So any business entity can use this tax planning approach to corporations, limited liability, partnership, a professional practice, law firm, medical practice. As a matter of fact, I'm working with a partner of mine, an insurance agent that's selling his practice, and he's using a monetized installment sale to do that. Real estate, whether it's for business or investment purposes. Personal residence, you can use it for your personal residence. It's a little bit different. Just takes a little extra steps, but it can be done. For divorce, fractional interest, mineral rights. Also, it's not just limited to commercial property. You can use it for cryptocurrency, baseball card collection, gun collection, anything that's of value that's over $500,000 other than securities. Okay, next one. Okay, this is how the sale is structured. This is how it works. There's typically, 3 parties in a sale, which is the seller, titled escrow, and the buyer. Next. And in a monetized installment sale, you'll be adding those additional parties to the transaction. That would be the second lender, and the dealer and another escrow company. And third-party intermediary, third-party intermediary, it's kind of set up like a 1031 exchange. Similar, everything is processed pretty much the same. So you add the dealer, the lender, and the intermediary. Next step. In this particular diagram, it's showing you how the seller never takes actual constructive receipt of the money. So your seller, if this is a typical transaction where the seller negotiates with the buyer, and then the seller will direct deed directly to the buyer. So, but the buyer is not aware of any of this. It just goes through, as far as the buyer knows, it's just a regular transaction being used as a 1031 exchange. Okay, next slide. This is another one of the diagrams that kind of shows the flow of how the process works. So this is pretty much toward the end where the title company gives money to the intermediary, and they hold that until the end of the sale. Then they give it to they give the money to the capital asset dealer. It'll come a little more clear in the next slide. Okay, now the requirements for this sale are there is no money down. The seller or the buyer pays nothing up front for this particular sale. It's interest only, non-amortizing for 30-year term. The asset dealer is 100% of the net sales proceeds. That goes to the asset dealer. Okay, next slide. And so here's another diagram that is showing the process. It's a little bit confusing, but what happens is the dealer has arranged for the lender to give a monetization loan for 95% of the net sales proceeds. So the dealer is actually taking out this loan, not the seller. So the seller is not obligated for any part of this loan whatsoever. And the 1% loan origination fee for the dealer's lender and 0.7% escrow fee for the second party escrow. And that's where you get the 6.7% in total charge to the seller. Next slide. So once the funds have gone through the lender to the seller, the escrow company will then release the net sales proceeds to the dealer. Next slide. Once the dealer has the proceeds from the escrow, they will invest that money at 7.5% or higher. Next slide. And then once the dealer has the proceeds from the buyer, they will invest that rate at 7% plus, and the dealer owes the seller $57,000 a year. Because remember, the dealer is using the seller's money. So he's borrowing that from the seller, and he has to pay interest on it at 5.7%, which that would be $57,000 a year in income to the seller. That's on the next slide.
And is that money insured? The money that the dealer's investing is full insured funds, correct?
Yes.
Yeah.
Yes. Okay, the next slide. This just shows a little bit more about the process here. The dealer has the proceeds from the buyer that they'll invest, and then the dealer owes the seller $57,000 a year on a monetization loan, and the seller owes the lender $57,000 per year. So the lender still charging interest to the seller. However, that comes out as a wash because the dealer is the seller $57,000 a year, and then the seller's paying the lender $57,000 a year. And it's a little bit confusing because it doesn't change. The seller is not involved at all at this point. The third-party escrow, the intermediary escrow, is doing all of this in paper. They never have to be liable or responsible or worry about this behind the scenes trading. Okay, the next slide. This is what I was saying, that it turns out as a wash at the end of the year. The seller will have to report that $57,000 as income, but they do also get to write off the $57,000 for the interest on the loan, because it's an investment business loan, not a personal loan. Okay, next slide. And the reason I can write it off is, like I said, it's an investment business loan, and it has to be used for some type of business investment. And they consider a business investment to be a savings account, CDs, mutual funds, stocks, annuities, index universal life insurance. What I have mentioned previously is another 1031 exchange bailout opportunity. It's also called oil and gas. It can be used to be invested in that. Anything that owns at least 1% interest is able to be used with this money. You can't just take it and put it under your mattress. It has to be gained in some type of interest, but you can do it in any investment of your choice. Next slide. So at the end of the 30 years, the dealer pays the principal, the constructive receive is issued, taxes become due and payable in that 30-year time. Next slide. As I stated earlier, it can be used for your primary residence, special cures needed, and one-time appointment required. One-on-one appointment is required with the intermediary and the dealer. I'm not too familiar with the primary residence. I haven't done any of those. So I've only done the commercial. Okay, next, investment property. Okay, so here's where you were asking about the insurance. Pretty much, so there's no default risk whatsoever for the seller. The loan is unsecured, and the seller's assets are not attached in any way, because the loan agreement is between the loan agreement between the seller and the lender provides that if the dealer does not make the payments for any reason, the seller is not obligated to make up for the dealer's default. This is the dealer's loan. It's not the seller's loan. So the lender looks to the installment contract for payment. No 1099-C can be issued, which is a cancellation of debt. The lender cannot go after any of the seller's other assets. The lender can't report any negative on the credit report, and the seller never applied for the loan. So he is off the hook. If the dealer can't meet the obligations or whatever the problem may be, then the lender goes after the dealer. Okay, next slide.
I will add that if anybody has questions, please put them in the comments in the chat, and we'll make sure that those questions get answered at the end.
Okay. This here is just showing about the yields usually over the last 30 years. So historically, over any 30-year time period, the domestic stock markets have averaged a yield of 9% to 11%. So anything over 5.7% per year is a profit for the dealer. And that's why they do these type of deals. And so people say, well, why are they doing this? Because they're going to make their money back. They're using someone else's money to make money. And that's why they're doing it. And 9 to 11% is nowhere near what they're making. They're really making more than that. Okay, and the next slide. Okay, this is just another example of the previous sale. So it says, what does nearly equal to the selling price mean? And then this is on that $1.8 million example previously, where the net sales proceeds from that sale was $1,692,000. The loan to the seller is 95% of that $1,692,000. And so 1% of the loan origination fee is charged. The 0.5% setup escrow account for the other escrow. The $300 per year, that's what the other escrow charges per year to maintain the transaction, to make sure all the swap and the wash carries out. And then the loan escrow fee, that's all deducted. So the amount to the seller in that case would be the $1,580,919. Previously, they would have paid they would have received only $1,100,000. So they're getting an additional $480,000, almost $481,000.
By not having to pay that $401,000 capital gain tax.
Exactly.
Right.
That's to be used for additional investments, another property that they don't have to worry about having to identify any team. That's where the bailout comes in. If they switch over to this, but they still want to get that, say, multifamily dwelling, but things didn't work out in timeline, they can still go after that same property with that if they wanted to. They can, but they have to. Well, they probably wouldn't have the funds for it, but they can invest in any other commercial property as well. It doesn't have to just be financial entities. It can be another property if they wanted to, without any deadlines, whenever they want to do it.
Right.
Okay, so this is a recap of a summary of what we talked about. So the seller enters into the purchase agreement with the buyer. The qualified dealer offers to purchase the asset from the seller through the monetized installment sale transaction, and simultaneously the qualified dealer will resell the asset to the ultimate buyer. Sales proceeds are paid to the qualified dealer. And then a third-party lender, that's the monetization loan, will loan to the seller an amount equal to 95%. The seller pays a fee of 1.7%, leaving him to take home 93.3% of the net sales proceeds. So each month, the long-term escrow company will automatically take an installment interest payment from the qualified dealer's funds and run through the escrow accounts to the lender. The seller or the borrower may then use the monetization loan proceeds, which should be non-taxable, as are any other loan proceeds, for any business or investment purposes which the seller borrower prefers, including to pay back debt on the asset being sold or to pay other businesses' debt. The seller borrower is, can't see what it says. Oh, thank you. It's not restricted in the use of the proceeds of the investments. So they can do whatever they want with it. And one of the I'm working on now, the insurance agent that's selling his business, he's actually taken the proceeds. He's going to invest in one of the other products that I was saying is life settlements or oil and gas. And both of those give you a 12% rate of return without any downside risk to the market. It's a really, really good investment. And like I said, it's a guaranteed 12% rate of return. So he's really tickled pink with that. But there's other options that are out there. And I mentioned previously before that about the oil and gas investment is also a 1031 exchange bailout alternative. And with that is unique because you can say you don't meet those timelines that you had mentioned earlier, Tommy, and you wanted to continue, but you want to switch over to the monetized installment sale. Instead of monetized installment sale, you can actually invest in an oil and gas program. And as long as the money is invested in that particular program, you don't have any taxes. But say 3 years at the end of the term, now you've identified a property that you want, you can convert back. That can also reverse, they can be another 1031 exchange into a property. So I can, if someone wants information for that, I can, send them those materials as well.
And we'll put your information up on the screen here shortly.
Okay. So like just recapping here, in 30 years on that 360th payment from the dealer to the seller, the principal from the 30 years earlier, and that payment flows through the escrow accounts to the lender to pay the loan, and the installment sale contract and the loan repayment are now satisfied, and the transaction is complete. And when did the taxes get paid? Now, the seller now has constructive receipt. When the seller files his tax return for the following year, he will report receiving the sales proceeds and will be subject to tax on those proceeds at the current tax rate at that time. Capital gains rates over the last 30 years has gone up 4 times and down 3, so we don't really expect it to change much. And if that questions and answers. I just want to make another comment about that 30 years. If the person has passed away and it is left to the heirs, a lot of times they do what they call a step up in basis. So they will actually, a lot of times, wipe out that capital gains tax. Okay, the next slide. Oh, this here is just saying, how does a lender make money? The lender is a non-institutional private lender and an affiliate of a long-time commercial mortgage lender. The affiliate was set up for the specific purpose of making these monetization loans. Mhm.
No, give me one sec.
Did you say to wait?
No, no, go ahead, Brenda.
Oh, okay. Okay, so as I was saying before, what happens if the seller dies before the 30 years are up? It does not, this is if it dies before the 30 years are up, okay? It does not trigger taxes due. All of the seller's assets, the installment sale contract, and the loan, as well as any assets that were purchased with the loan proceeds, become part of the seller's estate. So the installment sale payments continue to go to the seller's estate, and therefore the payments to the lender continue. And just as if the seller were still alive, there's no additional management required by the seller because it's already in place with the escrow. They're the one behind the scenes anyway. So this is much more valuable to the IRS than the 1031 exchange market because the market is being stimulated. The IRS eventually gets paid by the death of the seller, and the 1031 exchange tax goes away. And it's better than the 1031. You get new depreciation schedule. Basis carries over to new property, 27.5 years residential, and 39 years for commercial, and 25% recapture. And this here is a comparison, the 1031 exchange versus the monetized installment sale. So the advantages of doing the 1031 exchange, it's a lot cheaper in cost, a known and familiar tax planning approach. If they keep it until they die, then the heirs receive a step up in basis and don't pay any gains taxes for now. That's what I was stating before. And I don't know if it'll be that way in 30 years, but that's the way it is now. So next slide. And advantages of the 453 says they're much more flexible on what you can do with the money. You don't have to abide by the 45 or the 180-day restrictions. You can buy a property when you're ready and does not have to be of equal or greater value. You don't have to worry about any boot. You can sell high, buy low. These time restrictions also decrease bargaining power for the client. I know I've had a few people that just rushed into anything because they wanted to meet the deadline, and they end up getting it was way overpriced just so that they didn't have to pay those taxes. It provides a great exit strategy because they can put it into another business or any kind of financial vehicle like mutual funds, life insurance, savings account, pay off their investment property loans, etc. And you don't have to worry about what's available to buy because they can sit on the money if needed, as long as it's grown at least 1% interest somewhere. Okay, so if the client has a loan on a property and they are selling in a 1031 exchange, they have to replace that loan with equal or greater loan when to purchase the next property. So in this strategy, you don't have to replace the loan. There's increased depreciation write-offs each year. A seller's depreciation is based on original purchase. And with this strategy, if they buy another investment property, they get to start a new depreciation schedule based on the current property's value, which is really good. If they think that they will eventually develop an exit strategy, they greatly increase the tax bill by moving from one property to another because the cost basis remains with the original purchase price. For example, if we talked to some folks selling a $900,000 home who are buying a $3 million home, in one day, they add 2.1 million in taxable gains. With this strategy, that doesn't apply. So here is the process. First and foremost, talk to your tax professional about the strategy to see if it fits well with you. I work with a lot of CPAs and tax attorneys when it comes to this. Our company actually has a staff CPA that has CPA letters to present to your tax professional if you want to, in their language, so to speak. And and they can advise whether it's good for you in this year or next year or whenever it may be the right time for you to use this type of sale. Okay, so you would list your property with your agent as usual, or if it's already in escrow and you need a bailout, we would take it from there. Your property goes under contract with the buyer. You contact the company that we use is Life Equity Consulting to get the process started. The letter of intent is sent from the dealer to the seller. The documents are sent for your review and signature prior to closing. Communicate with title company that it's a 1031 exchange, or provide escrow with the attorney trust account wire instructions. For primary residents, do not communicate the M453 to escrow. They're saying it may slow down the closing costs, but that would be the case with Annie, because she's familiar with this. So we actually started one, and then the seller got a little nervous. But it's, yeah, in their experience, they've had trouble with some of the escrows not understanding. But it's really, if you know a 1031 exchange, it's pretty much almost the same process, just the better results. Okay, so once all the documents are signed and the transaction's closed, you'll receive your money. You won't get it the same day like a typical transaction. It takes about 2 to 5 days. The average is about 3 business days after close that you'll get the funds wired to your account. Okay, so contact your tax professional with all closing documents for the next reporting. And is this the next slide?
Yes, yeah, it is the next slide.
Oh, it almost looks like the last one.
Did you want to skip this one?
Yeah, we'll skip this one. It's pretty much repeating the same thing.
Repeating it? Okay.
Okay, and here, you can skip this too. It's already a disclaimer about not being tax professional. Okay, so when anyone who would like to start one of these that may have a client in escrow, investment property, or if you have someone to settle a business, or one of you may have a collection or anything of value that's over $500,000. If you want to get it started, we have what we call an intake sheet, and I could you would just email me. I could forward it to you or your tax attorney or whatnot. And it's really simple to fill out. It just we need to know the year the home was purchased or the property's purchased, the amount of that particular purchase price, but it does not include land. It has to be the purchase price minus the land. You know, it's improved property, and then land can only be the property portion of the purchase price. And then we just have to determine the cost basis like we did earlier, minus the closing costs, add the depreciation. And we have to have at least 5 business days. If it's in a situation where they're getting close to the deadline for the time frame, the 45 days or the 180 days, in order to convert it, it takes about 5 days to get everything in place. So they've done it in 4, but they really like to have 5 or more days to get it done. So does anyone have any questions?
Yeah, and Brenda's contact information is here on the screen. So feel free to jot that down, reach out to her. And, you know, if you have a client that this may be suitable for, she can then obviously help you there. But yeah, let's go ahead and open it up for any questions that anybody may have. Give me one sec here.
Oh, I wanted to add one more thing. If a property is going through the 1031 exchange process and it's just listed, it's not in escrow, they can also go ahead and choose this sale. The dealer will be the buyer directly and help them out of that situation. So it doesn't have to be an escrow.
Gotcha. All right. Any questions from anybody Esther, Marie, Betsy, Annie, Lisa, Daryl, anybody have questions that you may have? I don't see any questions in the chat. I would suggest that if you do have any questions, I will go ahead and put Brenda's contact information back up on the screen. Again, feel free to reach out to her. She has a website here, and then her direct office number is here as well. So please feel free to reach out to her with any questions you may have. Or if you have a client that, you know, is possibly looking or would like to, you know, invest from the sale of their property into other things versus just rolling it into another property, you know, she can definitely help you with that and answer those questions as well. Brenda,
I forgot.
you want to lead us with?
Yeah, I forgot to mention for anyone who is a realtor on this transaction, in a transaction, or you know someone who maybe is a commercial real estate agent who has an investor that is in this situation. If it's your transaction and you make the referral, the company will pay 25 basis points to the realtor because I'm a realtor. I'm allowed to offer that to another real estate agent, 25 basis points on the net sales proceeds as a referral.
Say that one more time.
And so we can offer 25 basis points as a referral to the listing agent on this transaction in addition to your commission. Gotcha.
So I think it's more of a question for Annie and Tommy. So on the last one that we attempted to do, Mr. G, we just didn't have time to complete it before he had to leave. So time frame, doing reverse engineering, when would you guys like to be involved in the transaction? Like if I take a listing for a commercial office space, would you want to be involved once we have the sales contract, or similar to what we're doing with the residential, where once we open, we get the listing, we open title?
Yeah, immediately.
Yeah, definitely. Right away. As soon as you get the listing, just send it over to me and I'll make sure that title gets it and we get the title going and the pre-escrow going.
Okay, perfect. And then with that, Annie, on the last one, were there any additional requirements for the seller from your end?
Not really, no. There's not, I mean, the same documents are needed, so it would just be the exact same thing.
So Annie, you're saying it's extremely similar to doing a 1031.
Exactly.
From an escrow perspective.
Exactly.
Okay.
Yeah, the only difference on the seller side is the dealer sends out paperwork to the seller agreeing to the transaction, and then they provide a letter of intent, and then they're setting up their end on that side. But you guys would handle yours just like a 1031 exchange.
Right, and they should include escrow at the same time. I mean, usually they'll go ahead and bring us into it also and start sending documents to us to help them.
Okay, so that, like we do with the 1031 exchanges, the language on the purchase contract should be buyer and seller to participate in a 1031 tax deferred exchange or with your product, Brenda, at no cost to the buyer.
Yes.
Okay.
Correct. Yep. You just want to say that they're going to cooperate at no cost. And sometimes they'll want to see no cost and or liability kind of thing.
Okay, perfect. And that's something we can do on the settlement sheet as far as it shows the X and Y's to the buying agent.
Correct. We could do that too.
Okay, perfect. Oh, got a couple coming your way.
Okay, sounds good.
Oh, the referral on the monetized installment sale to the agent would not be on the settlement sheet. That would be a separate transaction.
Okay.
And Brenda, just to clarify one thing is, you know, with the 1031, you're exchanging it for like property. So it's real estate for real estate. And with this, you can exchange real estate for really any
Cash.
business op, right?
Exactly.
Yeah,
It could
cash.
be, it's cash, yeah. Do with that cash anything you want.
Right. So somebody, an investor may look and say, you know, I have this fourplex or this 16 unit apartment building that, you know, I feel is probably at the height of where it's going to go. And their financial advisor may say, you know what, this is the time to sell that. They may take that out and say, I don't want to put it back into real estate right now. I'd rather put it into something that's going to give me a 10, 12% rate of return. They can invest it however they feel. Yeah.
Exactly.
Interesting. Interesting. Well,
And you know what made me look into this, Tommy, further? I don't know if you remember, but maybe 3 or 4 years ago, you were going through a
Yep.
1031 exchange and you asked me, and I told you I saw a product and they retook it off. A lot of the carriers backed away from it because they really don't understand the real estate market and they wanted to just the easy, you know, the easy peasy stuff. So it was hard to find them. But when the markets started going up and down, they started bringing these things back. I mean, they've been there, but they haven't been making them available. So I just kept looking and looking. And when you brought it up, and then finally it came to my attention again. So because of you, all of these people are going to know about this.
well, I think it's extremely interesting because it gives another avenue. I mean, most investors are not only investing one direction, so this definitely, you know, helps with that, right? And so, wow. I mean,
Right.
I
And
know.
there are a lot of business owners, say restaurateurs or small people that ends or some type of industrial plant or whatnot, that don't have anyone that wants to take over the business and they want to retire, but they're afraid because all of that big chunk of their retirement income, they didn't save all their life. So they were relying on the equity of the business and they got to give that to Uncle Sam. And now they can retire, you know?
Right.
And it's really big. That's mainly was one of the reasons too that they present this through the insurance companies, because it's mostly people that we're doing estate planning for, or you know, legacy plans. So it's really good thing. I like it.
Very interesting. So, well, Brenda, thank you for sharing all of this with us today. I'm
No,
sure
definitely. This is great.
you know, we'll get this reposted as well. I know we had a lot of people that had issues trying to log on to the Zoom for whatever reason today. So we will get this posted, and I'm sure there will be questions that will be asked. So stay tuned for those. But yeah, I mean, I think it's a no-brainer. I mean, especially if you have an investor that, you know, wants to sell things. I know a lot of agents that walk away from business sales in general, right? Because they're just not knowledgeable in a business sale. And this is perfect for somebody who wants to sell a business, but maybe not invest it in a like business, right?
Exactly.
Where you don't have to go find them a restaurant that they want to buy or something like that. They just want to reinvest it in a different way. And all you have to do is connect the dots. So yeah, I think this is huge. So, all right, cool. Well, if anybody doesn't have any more questions, we'll go ahead and wrap this up at the 34-minute mark, which is perfect.
Awesome. Well, thanks again, guys.
Thank you so much.
You're welcome.
All
Have
right,
a good
thank
day.
you, everybody. I appreciate you all jumping on. And if you have any questions, make sure you reach out to Brenda.